Hello, guys. Super happy to be here again on our show, the Trade Pod. And today we have Rodrigo. Rodrigo is one of the most inspiring people that that I met over the last month or two. I had a great conversation with him, and I told him, "Hey, let's jump over and let's have a podcast." And today I have him on our show, and it's an absolute pleasure. So before I'll dive deep together with Rodrigo. I would love to have a small introduction about yourself, mate. So, how are you today? And first of all, I want to thank you for being here. And yeah, tell the listeners a little bit more about yourself.
Sure. And thanks for having me, Avik. I appreciate the invite. Um, yeah, I'm Peruvian Canadian, now living in the Grand Caymans in the Cayman Islands.
That's a really
I'm
interesting mixture, by the way.
yeah, it's not terrible. Married an
It's
American, so
awesome.
I have all the things. I have all the nationalities that make it for a fun round trips every year to family and friends. Um, and what's my background? What's my history? I was born and raised in Peru. I was there until I was 8 years old. And the the interesting thing about my past that's going to lead to what I do today is that my I was raised in a family with four brothers and a father who was a math professor at the University of Lima. He was also in the Peruvian Navy, but his job in the Peruvian Navy was to do information technology. And at the time, in the 60s, 70s, and 80s, it was about bringing computers to Peru, specifically to the Navy. And as you may or may not recall, affect computers back then, in the beginning at least, took up rooms, not, desktops.
Mhm.
So he did his master's degree in Monterey, California, and then put a team together to start building the first information technology team for the Peruvian Navy. Eventually went off on his own, started one of the first software development companies in Peru, did really well for himself. And then in 1989, he had put all his money in a Peruvian bank. And in 1989, inflation in Peru went from 20%, which was manageable because you were getting interest rates in the 23% range, to 7,200% in 6 months without a commensurate raise in rates. And
Oh
so
my
the
God.
purchasing power that we had went to zero for all intents and purposes. And it was a devastating period for Peru, and it forced us to really emigrate. And that's how we went to Canada, got our visa, and built a life there. And so, very numerate background. My father tried. He actually did a very successful professional in the software space in Canada. But from an investment perspective, he kept making similar mistakes. He kept concentrating his risks and using concentrated leverage. So got to Toronto, we bought a house for 5% more money down right before a Toronto housing crash in the 55% range. And so, got hurt a few times. Also saw my brother invest at the peak of the tech bubble in the early 2000s to see that portfolio drop 70%. And so by the time I graduated from the University of Toronto, I studied commerce, finance, statistics. I knew I didn't want that to be my path. I wanted to see if there was a way to try to mitigate some of those major fluctuations in what everybody seemed to be to believe is an inevitable market crash. And that's when I got interested in using leverage to my advantage and creating all terrain portfolios. Started in the insurance companies in Canada, one of the largest insurance companies on their group plan side. Then I started managing money for single family offices. And then I moved on to Macquarie Bank and started managing portfolios for other advisors. Then when Macquarie left Canada, we had the opportunity to launch our own company called Resolve Asset Management. And in 2015, we launched that company and were able to be on our own for the first time outside of a bank structure, providing separately managed accounts, ETFs, and mutual funds for investing in very different ways than the average portfolio manager. And then the last venture that we launched in 2023 was a return stacked ETFs business, which again we can get into this, but it uses thoughtful leverage in order to create portfolios that are more robust and resilient to different market and economic regimes. So that is, and it's all of that journey has been in a very quantitative and systematic way. I'm not a gut-based investor. I have PhDs in my team that help us create portfolios that take into account constant data, different types of quantitative methods in order to make decisions, and 100% discipline in terms of execution. So I guess to put it all in a nutshell, I am a quantitative investment manager that deals in international funds, mutual funds, and separately managed accounts.
Mhm. First of all, it's a really comprehensive background, and I really understand what led you to take that decision in learning economics and how to make the inevitable risk onto a really great outcome out of it. Now, I would like to ask you, when we had a conversation by phone, you have mentioned that right now you're planning with, of course, some partners to have a collaboration to establish an EDF here in Israel. Now, taking the same structure that you have created over the past few years when you're running your company, I would like to ask you, how would you construct an EDF from scratch, and what's the actual importance points to add, so you'll avoid having mistakes onwards.
As in, you want to understand how one goes about creating an exchange traded fund structure. Is that the question?
Yeah, it is. Yeah, correct.
Yeah. So there's a couple of venues that one can take. You can decide to do it all on your own. And if you do it all on your own, there is a series of teams that you're going to have to put together in your organization and a series of kind of legal steps you're going to have to include in order to get it up and running, and then have the team continuously running that mutual fund and remain on side from a regulatory perspective. So this is exchange traded funds in the United States or in Canada, are under the guise of their respective regulators. In the US, it's the Securities and Exchange Commission and FINRA. And they have a very specific guidelines as to how you're going to put together your prospectus document,
Hmm.
what you're going to be investing in, and then how you're going to be managing that portfolio from a risk perspective. And that requires initially you normally want to go to a legal firm that has done these over and over again, kind of cookie cutter prospectus documents, so that you can minimize the amount of time and brain damage that you spend creating these documents. And then you're going to have to, once you have the offering document and the type of ETF that you want to put together, you file it for approval by the SEC. They generally take 60 to 90 days to provide comments. If they feel like it's not complete, you answer their questions, go back and forth until they're happy with the prospectus. Once they're happy with the prospectus, you now need to find, or concurrently, you need to start working on opening up accounts for the exchange traded funds, brokerage accounts. If you're going to be trading futures contracts, future commodity merchant accounts, bank accounts to be able to take in cash. You're going to need to then talk to the market makers that are going to be trading your exchange traded funds. You need to actually engage with a market maker that is going to commit to being in the middle of the market before your exchange traded fund is actually popular, right? Somebody wants to buy and sell. They're
Yeah,
going to have to
I
provide some
have a
liquidity.
question, and I would love to interrupt you because it really catches my interest. After passing all the bureaucracy, following the SEC needs and wants, and you got their confirmation. Now you're speaking about involving with the market maker.
Mhm.
First, how do you pick the right market maker to establish liquidity within the new EDF, basically? And what are the priorities that this market maker will follow in order to create the necessary liquidity to drive the new asset?
Yeah, so it'll depend on what you're going to be trading. So you're going to select your
Let's
market
go for
maker.
future contracts.
Yeah, so if you're trading stocks, anybody will take your money, and then it's about whether they want to deal with you, right? Because the way market makers work is they're trying to make money on the spread.
Hmm.
And they have X amount of money in their balance sheet that they get to spread around all of the ETFs that they've chosen to trade on. And so, or stocks that they're chosen to trade on. And so they can't guarantee you a lot of liquidity on your, they can guarantee you, they have run algorithms to provide enough liquidity where 95% of the time when people hit the buy or sell button, they're going to have enough already on the bid or ask to control and for them not to be spikes. But if there are going to be people that randomly put, such a large amount that's unexpected, it's going to go blow through the market maker and hurt you. And because there's also hedge funds and vultures out there trying to kind of pick you off. And so the way you select them is do they have a good balance sheet? Do they have a reputation for providing liquidity and working with smaller exchange traded funds in a real way? Because they're not making a lot of money from small ETFs in the beginning, right? So
Hmm.
do they do do they do a good job of dealing with you when you're small? And you have to make a case that you're not going to be small for very long, right? That you're going to be growing very, very quickly. And so the faster you get into size, the more attention you're going to get from the market makers. The smaller your exchange traded fund, the more likely you're going to get a lower service than you would otherwise, as it is for anything in the world, right? So some
Hmm.
market makers deal with futures, some market makers don't. There's a small handful of those that deal with futures contracts. And so that kind of limits the amount of market makers you can choose from. And then after that, you just constantly have to be vigilant that they're putting enough liquidity in your ETF in order for that ETF to function properly for your clients.
Hmm. I got it. Now, following the same topic of market maker, um, you have mentioned their business model, which is profit, which is having profit from spreads, and actually uh putting down like the effort when the ETF is just initially public for the people to trade. They do not make a lot of money by having a spreads like in the beginning. Now, I would like to ask you, in what way you construct with a market maker a plan or a contract or for future work together, because unless they get X amount of money out of their job, it won't be necessarily relevant for them. Now, I would like to ask you, how would you address those issues in advance in order to avoid misunderstanding situations in the
Yeah.
future.
Whenever you establish a relationship with a market maker, you establish uh, market level agreement, something that they have to abide by. They agree up front for X term to provide X amount of liquidity for exchange traded fund. It's that simple. It's a contractual obligation. Okay. Now
Hmm.
for them in the beginning, like think about it from the way they're placing dozens and dozens of bets, if not hundreds of bets across many different ETFs. And the smaller the ETFs are going to get smaller part of their balance sheet, and the bigger ETFs are going to get a bigger part of the balance sheet. And so, as a business owner, if you're a market maker, you constantly want to be having discussions with innovative ETF providers that have a potential for growth. Now, let's
Hmm.
say you engage with a market maker and they believe in your story because you have to kind of get them to buy in. They're not, it's not like
And
you
you
just,
as a company, you need
not
to
like,
absorb more and more success stories in order to build a conventional a trade record.
yeah, yeah. So those are, you got to do that anyway, right? But you also want to be able to have the option
They'll
of
have their
more market
decision.
makers because the better you do, then what ends up happening is like there is no monopoly in market making, right? There is just a minimum level of agreement from a market maker to say, while nobody cares about our ETF, I need you to provide liquidity and you're going to offer that. And we're going to, make sure that you are the main market maker. But as our exchange traded funds have grown, anybody can make markets in those ETFs. So I saw when we launched our first ETF from 0 to 25, it was just our market maker. When we went from 25 to 50, we started seeing two or three other market makers come in and try to take some of the revenues from the main market maker, right? They don't have an obligation. They don't have, there's not no service level agreement, but they want to make money and they see opportunities in these ETFs. So um, the bigger you get, the more liquidity you have, the more depth you have, the more market makers you have. And you know, the main market maker gets to pick and choose how much liquidity he wants to add to your ETFs. And if there's two or three market makers that are actively participating, then that's even better for the ETF from a liquidity perspective.
I assume that for those market makers who join in the really early stage of the EDF, they bet they bet, as you said. Now, when the EDF gets to a level where their capabilities, they reach onto some limitations, what do you do then? Now, you have a decision to make whether to collaborate with more and more market makers over time, and to establish more liquidity, or um,
Yeah,
another
I mean, you can
solution,
at
which
any
which which
point
I
you can
which I'm
reach
trying to
out.
brainstorm with you right
Yeah, at any
now.
point you can reach out to any bank and say, "Hey, National Bank of Canada, Goldman Sachs,
Of course,
RBC, do you guys look at my ETF? We have a lot of liquidity. We just want, you
super
guys should
sexy
take a look
EDF.
at it. Do you want to do that? Because look how well we've done, right? Like
Uh-huh.
you can make a concerted effort. There's kind of two dynamics here. There's your main market maker that you have an agreement with. And then after that, there are smart market makers out there that see opportunities and then just without you asking, participate. And then there is the opportunity
How did
for,
and they participate right after, right from their broker, like without even asking.
correct.
They driving
Remember what
liquidity.
a market maker, you can be a market maker,
Yeah, I know
right?
that I can be a market maker. I
So
operated those
like
funds.
anybody can be a market maker. It's just a matter of deciding what to make markets in. And
Mhm.
so there's no stopping people from creating liquidity and managing that liquidity with your ETF. And so what we have seen is organic growth of market makers for our ETF universe. And like you said, you can always talk to others directly and say, "Hey guys, you should look at my ETF for market making." And then you kind of spread the love a little bit.
Mhm. I understand. Now, all right, that was a really insightful lesson about micro makers. Now, I would like to take you back onto the construction of the EDF. You have mentioned that on within your company you hold a bunch of PhDs and bunch of really clever people who build and construct those EDFs together. Now, I would like to ask you, let's hypothetically say that right now you say to your people, hey guys, let's start a new EDF in futures. Um, what you will expect to have on your end by the end of the day, because you have like a really long period of time when you're going to be constructing the EDF in a much proper space. Now, um, I would like to ask you, which assets would you insert to the ETF? Under which market regimes would it pick to leverage certain assets in the place of others? How do you leverage those assets? I think, like, the puzzle of making such comprehensive planning for having a really sustainable ETF will eventually pay off better. Now, internally, I would like to hear the comprehensive actions behind constructing, building, whatever term that you would like to use, to finalize and execute a really substantial ETF.
Well, first of all, if you're going to launch an exchange traded fund company, you need to figure out what your story is. And this comes down to,
Story.
yeah, it comes down to you have you ever heard of the concept of product market fit?
The
Right? This is
PMF.
a yeah, this is a Silicon Valley and language that basically says, look, you can have the greatest idea in the world, but if nobody cares
It's
about it, nobody wants it, then they're not going to buy it, right? And what often tends to happen is that the ideas that the market wants are not as sophisticated as the ideas that you want to offer. And so the iterative process of creating a product is to say, hey, I have this amazing, super product that I'm going to go on the market. And the market says, not interested. And they're like, okay, why? I'm going to take this away and kind of I put it back in the market. It's like, I'm interested a little bit more. And you keep on iterating until you find something that the market's like, yes, That's what I want right now. I don't want anything more. I don't want anything less. We have hit at a point where there's product market fit. And so in order to do that, you need to do some work. You need to put together a marketing plan, get some decks out, do some analysis, see what's working, see what the market is really hungry for.
All right,
And
understanding the idea behind PMF, product market fit. Let's hypothetically say that all right, today as of December 10th, we would like to establish a new ETF.
yeah,
Now, how do you actually practically establish a really comprehensive marketing plan in order to understand if you'll have a need to trade on in the future?
well, okay. So if I understand your question correctly, how do you establish where the demand is? Is that what you're asking? And then how do you do it? Or
How do you find the demand and how do you establish it properly? Let's
yeah,
put
so
it
the
that
first
way.
one is just you get. So what we did is we have a big social media microphone. We have over between all of the partners, probably over 150,000 followers on Twitter. And I don't know what the number is on LinkedIn, right? So you can use that audience to say, hey, I just wrote this blog post about this idea. You should read it. And you get feedback from that. And people are like, oh, yeah, but don't like this, don't like that. And then you write another blog post and you say, hey, about this new idea. And so over the years, this has taken us, I would say 20 years to get to the point of good product market fit on exchange traded funds, right? You end up slowly but surely trying to figure out what makes the most sense for the market. For us, it was understanding number one that language is important. The actual ticker symbols and the actual names of the funds matter a lot in a weird way, right? Because a lot of
No,
people
because
have
this is
seconds to
really
make
marketing.
decisions, right?
This is
So
accurate marketing.
yeah, marketing
If
101.
there would not be if the EDF name ticker would not be fundable, it would not be easier to find you on the watch list. So
Yeah. So for us, for example, the concepts that we're putting in play are not old, are not new. They're pretty old. They're really old. In fact, they were established by William Sharp
how old?
back in the 1950s when he won the
Oh,
Nobel Prize for modern portfolio theory. Okay, so very old.
really?
Yeah, and the idea of for those
At least
geeks
he
out
got a
there
Nobel
in
Prize.
finance, that the efficient frontier and the capital market line, that's him. And the idea of levering a portfolio instead of going and concentrating more towards equities was his idea. And that idea is called portable alpha, or like a derivation of that is called portable alpha. Guess what didn't work in the ETF market as a name? Portable alpha, right? Nobody knows what that is. The average investor doesn't understand it. It's too sophisticated. The advisors don't get it, right? But portable alpha, in essence, is if you have 100% in the equity markets, you can choose to just buy the S&P 500, for example, ETF, and that's you're going to get the return of the S&P 500. Or you can use the concept of portable alpha by saying, look, I found this awesome hedge fund manager that actually makes money when the S&P loses money. It also, sometimes loses money when the S&P 500 makes money, but they both have an upward sloping equity. They both make money over time. And what I want to do is I don't want to sell my S&P 500 in order to make room for this hedge fund. Well, instead, what I'm going to do is I'm going to borrow money. I'm going to borrow money against my S&P. And let's say I want to borrow 20% of my S&P. And I go to the bank. I'm like, lend me, I got $1 million in the S&P. Let me borrow $200,000. The bank lends you $200,000 and you go and you buy the hedge fund. And in essence, your portfolio is now your 100% equity portfolio, S&P 500 portfolio, a 20% alpha on top of your 100% equity portfolio minus the cost of your borrow, right? And so that is called porting the alpha on top of the S&P 500, portable alpha. What we came up with in 2021 was after talking to the market that didn't understand what portable alpha was, they did understand something as simple as, hey, you're stacking returns on top of the S&P 500. And lo and behold, the name return stacking became a viral thing. And so people don't really talk about portable alpha all of a sudden. They talk about what we're doing as return stacking. And so when I talk to an advisor and I say, I'm stacking the returns of a hedge fund on top of the returns of the S&P, they immediately get it. Versus saying, I'm using portable alpha to give you better returns. They're like, okay, you're going to have to explain that to me. And so that was a key unlock in terms of product market fit. The name, return stacking, just is an immediate, most of the time just makes immediate sense. Right. So
Hmm.
I think that's the first thing if you want to be, that's just the first thing you need to do in terms of being an entrepreneur, period. You have to make sure you have good product
Of
market
course,
language.
100%.
And the
100%.
ETF, especially the ETF market, where you're not going to be doing necessarily belly to belly, dinners to try to get your people to invest in you. It's going to be more, you're going to put content out there, you're going to put information out there, you're going to write white papers, you're going to write reports, you're going to do videos. You want that to be as simple as possible for the audience to capture. And then the product itself needs to
Obviously.
be what people want, right? So I just talked to you about the S&P 500 plus 20% alpha. Is
Mhm.
that the best way to create a portfolio? Absolutely not. The best way, in my view, of putting together a portfolio is what I call an all-terrain portfolio that balances the risks of inflation, of bull markets and bear markets, so that you have a large portion of your money in bonds, a large portion, a smaller portion in equities, a smaller portion in commodities, and a large portion in managed futures type alpha products. And then when you put those together, it creates a much smoother equity line where you don't see losses in 2008. You don't see losses in 2020. You don't see losses in 2022. It just continues to make money. But because those things are so non-correlated to each other, you can then lever them all up pro rata in order to hit the volatility and return target that you want. Okay. That to me
Mhm.
is what I think everybody and their mother should be investing in. But nobody understands it. Nobody gets it. Why am I not making 40% like my friend in the S&P 500 is doing? Why am I only making 15? Well, it's because you didn't lose 55% when the S&P 500 was down 55% because we're not just the S&P 500. We're all this diversified. So there is we could have gone and marketed what we think to be the best portfolio on the planet. Well, that's what I did for 15 years. We grew, but we didn't go exponential. When the ETF world came, we're like, what is it that the people want? They don't want this all-terrain portfolio for the most part. What they want is to do better than their S&P 500, right? That's the product market fit.
Like everyone.
Everybody
Like
just says,
everyone.
I'm trying, they spend 100%,
But let me ask you
99.99% of their
this.
Cognitive
If you'll
power to
take
trying
if
to
you'll
beat
take
the
those
S&P.
people, if you take those people and you show them the accumulated return from the S&P, and conversely, like you're gonna be taking a photo, you're gonna be dividing it into two, and on the left hand you will show them the S&P and their and its cumulative return, and on the other side you'll show them 2008 till 2000 the 2000 January 25, and you show them basically the cumulative return. By the way, if you have you call it Pareto equity curve, and yours is much more smoother and it goes up and it goes like a no-brainer, and conversely the S&P doesn't. um what's what's the much more what can you do on your end that will be much more conventional for other people to join on?
Yeah, so that's you go as simpler, 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 simpler until people are like, oh, I get it now. I can do that. I can do that. I couldn't do what you were asking me before because you're too different. It's called tracking error bias, right? People really are narrowly focused on how did you do versus the thing I care about the most versus what my next door neighbors care about. And what I care about the most is when I look at the Dow Jones. How can you be charging me 2% when the Dow Jones was up 30% this year? How can you possibly, if you can call yourself a good manager, only be up 10%? Or even worse, how could you be down 5 when the Dow Jones is up 30, right? Like the problem is people can't have that level of disparity between the benchmark they care about and the return that you're giving them in any given year. They don't really
Hmm.
care about the 3, 5, 10 year period. They really
But
mostly
you're
care
breaking
about
the
the
efficient market hypothesis.
hundred
That
percent.
way, that way you're breaking 100% the efficient market hypothesis. How
But you're not taking
the
into
hell
account
they're not convicted?
you're not taking into account a very important thing here, which comes from the behavioral finance side of things. And this is where like traditional
What do you
efficient
mean?
market hypotheses and behavioral finance have always fought.
Hmm.
Think about the utility curve, right? Remember in economics that there is an efficient supply and demand curve, but that there's also comes in this concept of utility curves where people
Hmm.
make what generally seems non-logical decisions, right? For
Hmm.
example, my wife wanting to own a house, right? She's always just like that, and we need to own property, needs to be ours. And I'm like, it doesn't make any sense mathematically. I can make more money by investing in our strategies than I will from a house that's a single security that can go down. Like because of my experience as a young kid in the 55% housing crash, I don't want to own a single piece of property for the majority of my wealth, right? It's irrational to me, but there's a utility that my wife and most people in the world seem to have of owning the house. And that's why people make an irrational choice over and over and over again. In the same way, you
Mm.
have to marry. You have to what what we failed to do in this kind of quantitative analysis is that there's a vast difference between statistical time and behavioral time from an investor perspective. And the goal here is not to maximize the return stream. The goal is to create a portfolio that your investor is going to stick to long term. That's it. Let me say that again. The goal is not to maximize the return of the portfolio from a quantitative perspective. The goal is to maximize the chances that you are going to stick to a portfolio.
So people will have much more rational
Yeah. So
ability to make a decision.
so if I tell you that we have two subjects, one
Mm.
person is going to do this all-terrain portfolio. It's going to be a smooth line. They're going to be up positively through the tech crisis, the credit crisis, through the Ukraine war, through COVID. And they're going to just slowly but surely make money. And over time, this should outperform the S&P. And they have this other one that gets to invest in the S&P 500. Okay. Now, this subject here with the all-terrain, guess this subject with the S&P 500 is investing like everybody else and what everybody's talking to about in the news, what their friends and neighbors are investing in. And this client gets to be an outlier, a behavioral outlier, where there could be periods from 2015, 16, 17, 18, 19, 20, where the S&P is in the 99th percentile of outperformance to anything else in the world. And that you got this all-terrain portfolio that, yeah, it's making me a little bit of money, but I want that 25%. I quit. I'm now going to get into the S&P 500 at, the peak of 2020 right before a crash. And then they lose more, right? So this person that couldn't stick to things and is bouncing from portfolio to portfolio at the wrong time is going to be worse off than this other investor that invested in the S&P 500. And so what is the
Hmm.
goal of where did we find behavioral product market fit? Is we realize that what people really care about is beating the S&P 500, right?
Uh-huh.
And while in theory they all say yes, 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 I want diversity. I want to protect in bad periods. I want diversification in my portfolio, but I also want to make sure that I make the S&P 500 return. So, well, historically you couldn't do that because you needed to sell the S&P in order to buy diversifiers that would zig when the S&P 500 zagged. So it was just behaviorally unpalatable. Now, the concept of return stacking is to yes and that problem to say, okay, I get it. I get it. You want the S&P 500. But hey, why don't we stack this alternative strategy on top that actually reduces the downside risk of your overall portfolio because it makes money. It tends to make money when the market goes down and also has a return profile that's going to add an extra 1 or 2% return on top of the S&P 500. And so now you say to
Hmm.
the client, now you get to tell people, hey, you have something that has the potential to outperform the S&P and has a potential to make your maximum losses smaller. All of a sudden, people are like, I love diversification. I want more of that, right? Is it the thing that I would do? Absolutely not. but is it a good tool to offer the market to inch them towards more optimal outcomes? 100%. So I feel good about helping the world become more optimal, take their first 2 or 3 steps towards more of the efficient market frontier. And hopefully over time, they get less attached to the S&P and more enamored with an all-terrain so that they end up in the more thoughtful mean variance optimized portfolio.
Mhm. Now, speaking about diversification and what people needs and actually desires to have, let's speak about how to construct an ETF.
Sure.
Now, speaking about bonds and efficient market hypothesis, when US equities go up, bonds go down, and all those correlations and inverse correlations between financial assets, and of course, quantitative strategies in future and the other leverage assets, creating an ETF that will defend your capital when the market's like it's incredibly bearish and would know how to leverage your capital in a really conventional way when the markets are bullish. It's a hell of a mission. Now, how do you construct an ETF that would be able uh, or even capable in holding for longer periods of time, and on the same time, being conventional to the end clients of the ETF. Would you
Yeah, so I
think
think
it's
there's a couple of questions there, right?
yeah,
You
I
yeah.
give it to you because
Yeah. That's okay. That's
let's
okay.
have a flow.
It's okay. Um, you have what we just talked about is how uh, uh, people want to beat the S&P 500 still. That's still their thing. And I think more and more now
Let's
now
put
they
in
want to beat
place.
the Nasdaq, right? And then in short order will be like, can you beat Bitcoin? So that benchmark kind of shifts over time. But let's stick to I want to beat the S&P 500. Okay, so I just mentioned that it's going to be really tough for somebody to buy into something that reduces their daily up and down movement, i.e., their volatility, and also reduces the return at the end of the year, right? Um, so what we need to do is we need to be able to stack returns on top of the S&P 500 that have a high likelihood of zigging when the S&P 500 zags, have a high likelihood of providing positive outcomes and protection when the S&P 500 has its worst moments. And when you scour the universe of asset classes that fit that bill, there's only a handful, right? And they're not reliable. They're not all reliable all the time. So you mentioned bonds that make money when the S&P 500 loses money, right? By the way, is this being recorded? Like, are you going to show the screen or is it audio only?
You can definitely share a screen here.
So just to kind of put things into context here, this is let me just do total return here. Can you see my screen, by the way?
Yeah, I can see your screen perfectly.
Okay. So this is long-term treasuries in yellow, in orange, and global equities in purple. Okay. You can see that
Mhm.
in 2008, you did see treasuries go up nearly 30%
Well,
when the S
equities.
when the S&P 500 or the equity markets lost 35%. So an equal weight portfolio of the long-term treasury market and global equities would have actually made you just a slight loss, right? So if you were to stack the returns of the treasury markets on top of the returns of the S&P 500 markets, you now have the 29% plus the 34%, you would have kind of broken even, okay?
Mhm.
So this is fantastic as long as bonds go up when equities go down. And look, it was the same thing in the tech crisis. I don't know if you remember or if you've seen the tech.
I wasn't born by but by this year.
So let me just see if I can get S. S I think maybe this one. Yeah, let's do that one. So instead of global equities, I'm now switching to the S&P 500. Might have to go to the index route. All right. So during the 2000s, you also saw the bond market protect go up when the S&P 500 went down. This isn't going all the way back to where I wanted to, but you would have seen in 2000 making money. You would have seen it in 2020 during COVID. During COVID, let's go 2020. Right. So few people understand how much the bond market protected against the losses during COVID, right? Because what happens, people go away from risk and go towards safety, and this is a safety asset. Now, this sadly only works as long as the bear market in the S&P 500 is caused by risk off. If the bear market is caused by inflation, then you're in a heap load of trouble. And what we saw in 2022 is that bonds and equities went down together. Yeah.
Mm-hmm.
So this as a stack is not going to keep people invested, especially given what has happened recently or within bonds and equities. So when inflation shocks continuously exist, bonds and equities go down together. That's not great, right? Gold, gold at times acts as a hedge, but it's not reliable either, right? That's gold there in blue. It's pretty good, but it's not reliable. And so then you have to go into actively managed strategies and there's, dozens of categories within the hedge fund industry. And when you scour through those categories, what you find is that there's only a handful of alternative strategies that, number one, actually have zero correlation to the S&P 500. And number two, have properties that make them highly likely to make money in bear markets. Okay. And the main category that is known for this is the managed futures trend following category. Have you ever heard of that, Affect?
No, actually, I would love if you can do in essence, in essence point.
Yeah. So back in the 70s, there was a group of traders called the Turtle Traders. Okay. And there's a book called Market
The
Wizards, that
turtle.
Turtle Traders. And there's a book called
Mm.
Market Wizards that follows their story.
Yeah, of
And what
course.
they
Mm.
basically found is they could easily have trading instruments using futures contracts. And because futures contracts are so useful from the perspective of shorting, that you could easily go long or short U.S. equities, Canadian equities, European equities, Japanese equities, long or short. You could go long or short US bonds, Canadian bonds, UK bonds, German bonds, and so on. You could go long or short all the currency crosses from the currency cross perspective with a futures contract. And you could go long and short dozens and dozens and dozens of commodities like cocoa, uh, grains, and oil and gas and natural gas. There's hundreds of futures contracts to choose from. And what they were doing back then is they were looking at moving averages and they're looking at breakout systems. And if they were in a positive trend, they would buy them. And if they were in a negative trend, they would sell them. And when you do
Mm-hmm.
that over and over and over again for any single market that you do that for, you're going to be right around 52 to 54% of the time. Okay. If you do
Mm-hmm.
that over dozens and dozens of markets, if you have a two-sided coin that is weighted, that's in your favor, it'll feel like a lot of volatility, but over time you make money. But the key aspect here, Afek, is that when there's a lot of trends, these trend following managers tend to do really well. And guess when there are a lot of trends in the market? Generally, when there's a lot of bear markets, right? When the market's
Of
going
course.
chaotic, what happens? S&P 500's down. Like I just showed you 2008. Like 2008 is a perfect example of how clear trends can become, right? Am I still sharing my screen? Yeah.
Yeah.
2008, how clear trends can become, right? Uh,
Mm-hmm.
Beautiful downtrend here in equities. beautiful uptrend in bonds, not so much of a trend in gold, right? But you could do the US dollar was trending upwards. Like there's a bunch of stuff that you could capture. And so that category, there's an index called the SocGen Trend Index that um, that has the reputation of making money in bear markets. That's the green line right here,
Wow.
right?
That's really
Because
smooth.
it went wrong. It went long treasuries. It shorted equities. It was chopped up by gold. It went long the US dollar against other currencies. It went short commodities and it smoothly made returns, right?
Hmm.
In And importantly, in 2022, when bonds went down and equities went down and gold went down, guess what? They were short bonds, short equities, and trading around gold and currencies and whatnot. That's the green line right there, right? So now let's go
Like a
back.
piece of art. It is,
Now,
it is exactly like a piece of art.
yeah, and it's been around for 40 years. Okay, now why isn't everybody doing this? Why isn't everybody investing in trend following? Well, because it turns out that it does really, really well when there's a lot of trends. And the rest of the time, it's kind of mediocre. It does kind of like 3, 4, 5% when there are choppy trends and you're getting in and out of trends that are not productive. Not you make money over time. So if I go back to the beginning of this index, you can see that green line is made 150%, but it hasn't made 366%, right? And so when your index is the orange line, and I say to you, hey, look at this non-correlated line that made 150%, you're like, why would I take away from my 350 to add 150, right?
Hmm.
And that's even though it provides this diversity and provides this balance, it's not a good product market fit. People care too much about this orange line. Yeah. So how do we remedy this
That's a real
problem?
sophisticated engineering problem to
Yeah.
construct an ETF.
And so how you actually see if I can find how you actually solve this problem is by stacking one on top of the other, where you have 100% here, and you have 100% equities, but then you borrow money to stack the futures on top. So now all of a sudden, this black line that's the S&P 500 that everybody wants to own and everybody loves, and this green line that's these trend index that everybody hates, so especially since 2009, when you put this on top of this, you get this gray line, right?
Wow.
And now you get an index that is likely to perform just as well as the S&P 500. Probably, if history is any indication, you're going to see a high likelihood of outperformance, and you're going to see it most years, right? And the correlation to the CTA trend is 0, 0, 0, 0 to the bonds, to stocks. And then in the worst periods, the worst bear markets that we've seen, that's a black line here, 40% loss in 2000, 2002, 55% loss in 08, in January, 20% in the COVID crisis, another 25% in the Ukraine war. In every one of these circumstances, you've seen the CTA trying to really provide offsetting returns, right? And so the
Hmm.
concept here is if you give somebody an ETF that has all the returns of the S&P plus all the returns of a diversified asset that tends to make money over time, but not at the same time, you can now stack returns without necessarily stacking the risk that comes if you were to add the volatility of one plus the other because of the correlation, right? And
Hmm.
so ways of using that product that again make it a product market fit, as you say, the average investment advisor has a 60-40 portfolio, 60% equities, 40% bonds. All right, you want to keep your 60-40, great. Guess what? Sell 10% of your equities, sell 10% of your bonds, buy 20% of this 100 ETF. That's the green stripe one, right? So your portfolio line items look now like 40% equities, um, sorry, 50% equities, 30% bonds, and 20% this new product. That's what it's going to look like. It's going to add up to 100%. But inside this structure, this ETF structure, we're actually getting 2 for 1. And so when you put your X-ray goggles on, you're getting an extra 20% stacked on top. And so this is kind of how we've gone to market and how we've made it so that people can have their cake and then eat their diversification too. Is that making sense?
That makes an absolute sense. An absolute
So
sense.
that is the way that we have gone to market. As you can see, it takes an understanding of how people think, behavioral finance, quantitative finance. And then, we've launched a number of ETFs, 100% equity, 100% trend, 100% equity, 100% bonds, 100% bonds, 100% futures yield, which is another managed future strategy that can go long and short based on the expected yield on those futures contracts. And so now you have these parts, these building blocks, where you can just do a simple, hey, I just want to add these things on top of my traditional portfolio. Or
Mhm.
if you care, if you like all terrain, then you can use those building blocks to actually structure a portfolio that has gold, equities, bonds, managed futures, trend, managed futures carry, and other things, so that you create an equity line that's much smoother, but not going to be correlated to the benchmark that you might care about. So you can actually now you have the tools. All you need is the assembly instructions for how to put that together. And our website has a bunch of blog posts and stuff that people can look at returnstack.com to kind of experiment that from that.
Super. Now, Rodrigo, when we had a phone call, you have already mentioned that you released 4 papers.
Yeah.
One is technical alpha, sensitivity with withdrawal and longevity. You have global cape model and adaptive asset allocation. Which first I would like to have discussion a little bit more about those papers and asking you what led you to write down a paper, and what led you, and like the more interesting question would be that what led you to bring a proper solution to the problem you had before you even started to write down the paper. And how do you allocate, by the way, the right people to solve the upcoming problem that you might have now on your end? I see that you went on to table with the same guys, Adam Butler, Andrew Butler, and Mike Pandrick, and yourself. But besides one of them, but it's a really great question that I would allocate onto the you know
Yeah.
my budget questions in one
Look,
segment.
I guess what you're asking is why do we write the papers? Why are they useful? And then how do they help us solve problems for the end client, right? The
Mm,
papers that every year we aim to write a thoughtful paper that helps advance the knowledge of portfolio construction for the industry. And it really is normally not geared towards individual investors. It's geared towards the quantitative practitioner. And the way that helps is, from a business perspective, you have to create credibility that you actually know that you put some thought into the process that you're executing on. Because as you know, if when you put portfolios together, there's a little bit of signal and a lot of noise, right? So if I just am a closed company that decides to run a single fund, and we go through a 3-year period where the S&P is up 15, 15, 15, and we're up 8, 12, and 3, people are going to look at that and say, what's the point? What are they trying to do? Like, they don't forget about these guys, right? But what you have to do is you have to explain what you're after, what you're creating, why it's it's important, the rationale behind why it's more robust over long periods of time, and you get to build your case. And these tend to be 35-page white papers with a lot of math, um, that the decision makers at the top of these banks and investment houses and pension plans can read and say, okay, these guys that Resolve Asset Management, they know what they're doing. At least they're thinking through the process in a thoughtful way. Because the only way one should choose a manager is they should choose them based on their understanding of the process of their investment thinking. Are they a thoughtful team? Are they taking risks appropriately? Are they recognizing data mining issues and backtesting issues? Are they for real? Do they recognize their own blind spots? And the best way to do that is with long form white papers. So we aspire to write one or two a year to show the world our thinking, to kind of open up that top of our brain and say, look, just peek through and see what we're all about, right? Instead of being a black box, we like to be a glass box, and that has helped us quite significantly in getting people
Really?
to buy in. Yeah, because then you don't really. I mean, nobody should allocate to managers based on their performance because they could have gotten lucky. Like if you
Mhm.
don't understand the process, then and you just invest based on price movement, the moment that price goes down, you lose all faith. And so you have to buy, you got to get buy-in. You got to get converts. You got to get people that truly understand your process, believe in it. They understand, they care about the process, not the outcome. The outcome should come over time. And these white
Mhm.
papers help us put that into paper and for people to really review long-term data sets from 1970 to now, understanding, the mechanisms by which they work and by what an all-terrain is or what a momentum-based strategy does or what a futures-based strategy does over time or a carry-based strategy. So they can understand the character of what we're putting out there and then make more thoughtful decisions about who to allocate their money to.
Super. Rodrigo, I would have to say that conversation we just had was one of the most interesting conversations I had over the entire period that I'm running the podcast. I just understood what I have ever spoke about with anyone.
Wow.
Yeah, yeah, absolutely. It was a significant experience for me. When I usually when I have podcasts on, I bring on some really great people, but honestly we speak about things that I already know or already absorbed. And now when we spoke about like the issue that we're running on our side in much more depth and like bringing on your experience to the table was an incredible experience and was highly significant for me. And I hope that it will be highly significant for the people who listen to this episode. So, first of all, I would like to thank you for all the insightful lessons that you have shared with us today. It was incredible, like by
Thank you,
one
Alec. I
word,
really appreciate it.
incredible. And I really appreciate that you came here and spared a little bit of your time and shared your knowledge. The thing that I will suggest the listeners to go is to follow Resolve Assets Management on LinkedIn, Twitter, and to go and read your papers. There are four, so don't get scary. And thank you, Rodrigo.
No
Muchísimas
worries. And,
gracias.
and if somebody wants a master class on this stuff, there's two places you can go. There's
Mm,
we created an audio only podcast called the Resolves Masterclass. And so if you just go to the
Spotify.
Spotify and go Resolve Asset Management Masterclass, it's 20-minute episodes. I think there's 10 of them. And they walk you through the process of how we think about creating an all-terrain portfolio. The other place is on YouTube. We have a podcast where we interview a bunch of people, but there is a playlist in YouTube if you look up Resolve Asset Management, there is a playlist called the Resolve Team Investment Mastery that are all the podcasts that we've done with just the internal team talking about proper portfolio construction. And so
Mhm.
if anybody wants to
Yeah, I look
learn,
at the playlist right now.
yeah. if anybody wants to learn, and I've kind of ranked them from I think one most important to kind of more niche. Um, and the podcast started during the COVID crisis when we missed arguing with each other internally, so we just decided to do it publicly. But yeah, I would start with the Resolve crew on optimizing risk parity and stacking alphas. That was a pretty good one as well. So yeah, take a look at those, and then for the stacking stuff, you want to go to returnstacked.com and read through that. We have a few webinars, podcasts as well there for people to learn more and more. I'm really actually excited about what's available to the average investor these days, and all the knowledge is there for people to really do better and minimize the amount of risk that they're taking for the return that they're getting. So I'm happy to be out there talking about it, Avik, and I think what you're doing for your community is great.
Thank you. I really appreciate it. I already signed up for a Resolve Asset Management podcast and everything else. So again, I would like to thank you for everything. It was highly inspiring. And yeah, for more future events like this.
Yeah. Yeah. And you'll keep an eye out for our first non-North American collaboration with an Israeli team coming out in the next couple of weeks. So we're excited to work with you guys. Well, with the, doing more and more stuff
With
with
the Israel
Israel.
people. So you're gonna come over.
We're probably going to do some due diligence at some point. Yeah.
Mm. So when you have due diligence with with the guys here in Israel, I'll invite you for a cup of coffee and we'll talk.
That was great. Looking forward to it,
Thank
Alex.
you. It would be a pleasure for me. All right, mate. Thank you. I really appreciate it.
Not a problem. I'm
Have
glad
a
you
great
enjoyed.
day.
Yeah. Let me know when it's all ready to go.
Of course.
All right.
All right.